Hello and welcome to the Plain English Finance Podcast, the podcast dedicated to helping you make smart financial decisions. I'm your host, Trey Bino, financial planner with TC Wealth Management and Aviso Wealth. For more information or to send in your questions, check out the show notes at treybino.ca/podcast. And if you want to learn more about me, start with episodes 1 and 2. Let's get into the episode. So this one, we lied in the last one, because this one is not about TFSAs. That will be the next one. This one, we are joined by my brother and sister-in-law. Speak.
Hello. I'm Trey's brother-in-law, Sierra's or Cease's brother.
Hi, I'm Amy. I am Tré and Sierra's sister-in-law, their favorite Asian Korean sister-in-law.
We just did this one and now we're redoing it, so this will be fun. Second time's a charm. Okay, this episode, we did the first part, so you still don't know what the second part of the podcast is about, but we will go back through the first part again. So it's about using a financial calculator. Have you guys ever used a financial calculator before?
No.
You liar.
Okay, before about 20 minutes ago, I had never used the financial calculator.
And yes, I have.
Actually, I didn't mention, which we should. Why do you know about anything about financial stuff?
I'm taking my designation as a personal financial planner through Canadian Security Institution. So, yeah, don't come for me for advice. Obviously, I don't have CFP, but I do know about personal life, I guess, like planning, like the very basics of planning and investments.
Yeah, she's early in her career. She's learning. It's great. It's I am a nerd, so it's nice to talk to somebody that knows what I'm talking about sometimes. Okay, so we'll go back to square one. Financial calculator online. So we'll type in finance calculator into Google, and the first one that comes up will be calculator.net. You see it? Okay. And there are some symbols there. What do these symbols mean, Nick?
Without looking.
I'm just gonna...
you can't look this time. No. You can't
Future
look this
value, FV.
time. Okay. And what does PMT stand for?
Periodic payment. I remember that one.
Okay. I/Y.
Interest
No.
per year. It definitely says it on the calculator.
What's
so
the next two, though?
Okay, what's the next one?
N.
N is number of periods.
Yeah. And then PV.
Payment value.
Present value. It's close.
Okay.
Okay, so when would you... Now you can explain it. When would you use some of these?
Me?
Yeah.
Okay, well, so N, number of periods.
No,
is...
when would you use it for? Like, general financial calculator.
Oh, okay. So the most basic time you would use a finance calculator for the general public, such as myself, is let's say you want to make a down payment on a home. So you know that, okay, the down payment costs $10,000. So, and we want to have this house in 2 years. So then you would use a finance calculator to calculate that.
That's such a great illustration. I couldn't have said it better myself. The numbers were a little wild. $10,000 for a down payment for a house.
And in 2 years.
I'm not sure what century this home was purchased in, but correct. That's kind of when you would use a basic financial calculator. I think that I think it should be part of the school curriculum to learn how to use a financial calculator. I think it teaches you about money in a way that you can only really understand by seeing the numbers. So we will look at some of these numbers. Before we did payment value. Yeah, let's do it. I think the payment value is the best. The payment one's the best one to illustrate. So make up a scenario, Cease, that we're saving for.
We're saving for a Disney cruise to take our eye on.
Are we invited?
Yes.
Yay!
If you can afford it.
Oh.
You're gonna find out.
Yeah. Financial math calculator, everyone.
Okay, so we're going on a Disney cruise. How this Disney cruise is, let's say this Disney cruise is $27,000. So where would we put the $27,000?
You would put it as a negative number in the future value.
Why would it be a negative number?
I can't remember.
That's okay. I'll explain again. So it's the way I think about it is that you're giving this money to somebody and then you're taking it back. So when it's a negative number, you're taking it back from them. So it's negative for them, basically, how I like to think about it. It's like, think of it giving it to a bank. So I'm giving them $10,000. That's negative for me. I'm losing $10,000. They're gaining $10,000. When they give it back to me, they're losing $10,000. I'm gaining $10,000. Make sense? Yeah. So because they are giving it to me, it's a negative number. The present value is what I'm giving to them.
Wait, if you're giving it to them, then you said that's a negative to you, no?
Yes, but the calculator is in from the viewpoint of the bank.
Okay, gotcha.
So they're gaining that payment from us.
Yeah,
Okay.
so it's positive.
Makes sense.
Okay, just like it's not the true perfect reason, but it's a good way for you to memorize it. Anyway, so we'll start this $27,000 excursion or whatever at $0. We have no money for it. We're going to put the interest per year at 6% because why not? And then number of periods. How many years do you want to do this in?
I said probably when she's 8.
So that's 6 years.
8.
No,
7.
she's not.
7.
7 years.
7.
Okay, 7 years. Yep. 6%. I messed that up. Okay. Perfect. So just like last time, what have we got there, Nick? What do we need to do?
Okay, so after pressing calculate, I see PMT is $3,216. So you would have to pay each period or each year, we've said, $3,216 to afford this cruise.
Perfect. And then, so what's the sum of all periodic payments?
Sum of all periodic payments, $22,516.
And then the total interest?
$4,483.
Perfect. Okay, so what does that mean? Anybody?
Yeah, sure. So we put in ourselves our money, $22,516, and from the interest of the 6%, we have gained the 4,483.
Exactly. So this is where time, the value of time comes into play. We can all change it to let's change it to 14 years that we're doing the same
everything.
saving, same everything around. What do we see then? So how much do we have to contribute to get the same amount of money?
Okay, so after doing 14 years, now the payment, the PMT, is way less, $1,284, and the total interest went way up, $9,012.
So about $5,000 difference approximately.
Yeah. So what you'll see is that the longer the time frame that you have to invest, the less you have to put in as an individual, and the more interest will do the heavy lifting for you. And this is why I think everybody should have to learn this as a fundamental skill, because this teaches it you in black and white that you cannot afford to waste time. This is why, we often talk about you not being able to catch up.
I always say it's time under tension, but that's not the right. It's like compounding interest, but I always
Time in the markets.
Time in the markets. Yeah, it's a kind of a joke between us, but I always say time under tension when I'm talking about having time in the markets, starting young and that.
Yeah, which Nick's into working out, so he probably relates more with that than
I'm on attention.
the other way around. But what you see here is, so do the same thing but change it to 20 years, and you'll see a similar theme that now you're putting in $14,000 and interest is making up $12,500 of it.
So you're only contributing pretty much half,
Yeah.
and you're getting the rest of it from the interest.
Exactly. And this is why like car loans are so painful. So because people think when I say, okay, you should save for a car before and just pay for it in cash, they're thinking to themselves, oh, I have to save $40,000 for this vehicle. No, you don't. You have to save whatever you have to save in order to have $40,000. When you're investing, that isn't $40,000 of saving, because interest will make up such a large portion of it. If you're saving up for this car and you're investing for 10, 20 years prior to paying cash for this car, then you might be paying less than half. You might be paying a quarter of the price of this $40,000 car. It might have only cost you out of your day job $10,000 for a $40,000 car. But when you take out debt for that, you are guaranteed to be paying not only that $40,000 plus interest, all from your paycheck, all from your day job. So that's why invest young, invest early, and invest as much as you can, and learn how to invest so that you can get as much benefit as possible. If you was invested over the last 5 years in the stock market and you put $100,000 in there and did nothing, it's now worth $200,000, and that's $100,000 that you didn't have to do anything for. It just appeared. The price of that was a few sleepless nights during COVID.
We love free stuff.
Yeah, free money is the best type of free stuff.
The other thing I just wanted to say really quick is that we are using the future value as $27,000. That's the price of the cruise today. So the other reason why I would say investing is the way to go is because that if you're waiting, it's very likely that the price is not going to be the same. That's another thing we learned in COVID, is that sometimes there's big jumps in with inflation, I should say. So it's like in this scenario, it's like, yeah, 20 years, you're going to have, you're setting aside $733 and the interest is $12,000 and all of that. Like at the same time, if you were just, imagine if you weren't investing that. Now the price for the cruise is like $35,000, $40,000, whatever. Like it goes up as well. So it's like really the only way to kind of keep up is to have that. Like it would be so hard to just use savings accounts. Like who would actually do that?
You would. That brings in an entirely new topic, which I'm not going to go too much into, but I will show you how to calculate inflation. So does anybody know what tab we would use for that?
For inflation, I would guess interest per year.
Future value.
Future value.
So what we're going to do is we're going to figure out how much something would be worth if inflation is X in the future, right? So we will use, or does anybody know what the current inflation rate is in Canada?
Yeah, let me just say.
We're waiting.
7.
Trey, why don't you say it?
Okay. Well, we're going to use what I use for a lot of financial planning projections, and we're going to use 2.5%. So it has actually come down a fair amount. So we're going to use 2.5%.
So I put 2.5 in the
interest per year, and we're going to do it over. Actually, what? Let's do it over 20 years. Okay. So present value. So how much is this item that we're trying to figure out how much it would be worth in 20 years? Let's do a. Let's do. You said gym equipment, didn't you? Okay, let's do gym equipment. Why
gym
not?
equipment, yeah.
Yeah, let's do it.
So we talked about.
So let's do. You said $5,000 for this equipment. So that would be your present. Your present value is $5,000.
So for some context, I want this gym equipment. It's $5,000, and I have a set amount that I want to put away each month. But anyway, that's where we're getting these numbers from.
Yeah. If you could hear the episode that we half recorded that got cancelled and we don't have, you would know more. It's painful. Okay. So future value, present value is $5,000. The periodic payment is 0 because we're not factoring in a payment. And we will get what? What does it say? Future value.
So this is inflation.
Yeah, this is inflation.
So negative $8,193.
Yeah. So basically that means that $5,000, if inflation is 2.5%, the same thing, the same value
20 years
is $8,193, right?
Pretty
And that's
crazy.
if it is a 2.5% inflation rate, right? Think the issue with COVID, for instance, is let's use the same number and let's change it to 7%.
Oh, like I said before. No, just
Oh.
the I. Yep.
7%. Okay.
So over that same 20-year period, let's say it was 7%, which would be very bad. How much is it now?
My $5,000 gym equipment is now almost $20,000.
Yeah.
$19,348.
Yeah, very, very expensive. So that's why inflation is happening. Ideally, it is not at 7%. And inflation isn't a bad thing. There is good things to inflation for the overall economy, often bad for the individual. But it's why it's important not to just save, not to just stick money into savings accounts and hope that it still can buy you the same amount as in 20 years, which is why I always preach what I preach, Cease.
Don't save, invest.
No, invest at the right time frame.
Right. I was gonna be saying, this is not the first time you've been like, what do I always say? And I'm like, which one are we talking about here?
Invest at the right time frame. Pick the lowest risk option for the time frame, and I can guarantee it is not the same investment for every single time frame. There's not much I can guarantee, but I'm pretty sure I can guarantee that. If not, I'll take it out of compliance. All right.
So I had a question about interest per year, because we mentioned that it was 6% when we were doing the calculations before, but you said that my interest per year would be different from someone else's based on like my investments currently. So how would I find out what my current interest per year is?
Oh, that's a one hell of a question, Nick.
Okay, I've got like 5 years to go off of from my history.
So this is actually how would I explain it? Okay, so we get a ton of information, and as a financial planner, we get given guidelines. So a bunch of people get together and they look at current markets, where they're at, what we have seen historically, based on something called asset allocation, which is your mix between fixed income and equity. So there is a certain amount of expected growth in equity, and there's a certain amount of expected growth in fixed income. So based on your mix, I can then take your mix and use that and project what a reasonable rate of return to expect in your investments would be.
That the standard of deviation?
No.
Sharp ratio?
No. That's none of those things. But they are ratios. No, it's purely if you typed into Google FP Canada guidelines,
okay,
you'll see 2025 projection assumption guidelines. You see that? So if you was to go in that, you get a very nice short document of 22 different pages.
Oh wow.
But if you go down to page 19 or page 20, you see the
page 20.
Yeah.
Is that?
Yeah, it says 5
gotcha.
guidelines for 2025. So this is what I use when I'm doing financial planning for somebody for the long term. So inflation at 2.1%, short term fixed income like general fixed income, Canadian equities, US, international, emerging markets, borrowing rates. So that would be like mortgages and things like that. The YMP, that's like government brackets, income brackets, let's say, for different things, how much they increase by. Yeah.
So the borrowing rate, would that be like an average between mortgage, car loan, line of credit?
This is what we'd use for a mortgage. So you
For a
would
mortgage.
increase it based on other things, right? Like, and that's more like, for example, for a line of credits, I would do the mortgage, this rate, plus 2 or 3, depending on the individual,
Oh, okay.
right?
Okay.
So car loans, probably, I'm going to be telling you not to do it anyway. So
And then this is not factoring in the prime rate, or it is?
this does not factor in prime rate. This looks at prime rate over a long period of time
Gotcha.
to make reasonable assumptions. The thing about a lot of financial planning, we looked at this in a different episode where I showed some planning stuff, and the further out you go, the wider the range of outcomes is. So it's kind of like next 5-10 years you can be pretty accurate. Next 30 years you have a rough range, and that range is millions of dollars.
Gotcha.
But you can kind of know, okay, is this a good decision or a bad decision based on the expected range of outcomes, right?
Understood.
But anyway, that's how you would know. That's very way too detailed for somebody to be doing individually, because you still need to factor in fees and etc. If you go to the next page, you'll see that like the application of it. So I wouldn't go down that route, but I honestly would just look at your past 5 years return and kind of use that as a rough guide.
Benchmark.
As a benchmark.
Undercut, maybe, if possible.
Yeah.
It's pretty good though, because it was kind of during COVID, after COVID, there were some crashes.
The last 5 years have been really good in the markets, so it might be a little high. Maybe do that minus like 2%.
2%. That's exactly what I was thinking. Okay.
But again, it's not we don't know what the future holds, so you can't do it perfectly, but it'll give you an idea. And obviously it's better to invest more than not enough. So, okay.
Thank you.
Any other questions about that one?
I'm good.
Some of that stuff you and Amy were talking about completely went over my head,
Oh,
as I'm
okay.
sure it will for many of you listeners.
that has very little to do with it's fine. Okay, so any other questions from anyone for that stuff?
Nope.
Okay, what time are we on? 25 minutes. Okay, I know that you've been looking at a few different stocks and stuff.
Oh boy.
So,
Yep.
so I
This is my
wanted. No, we're not going to be looking at the individual stocks. We're going to be talking about some of the metrics around them.
Okay.
And I want to make sure that
Boy.
we understand what they are and the impact that they have.
Gotcha.
Don't be nervous.
I'm about to get exposed.
Okay, so we're going to start.
Hopefully mom's not listening to this one. Sorry, hopefully mom's not listening to this one.
High risk, high reward.
Okay, so we're going to start by looking at Home Depot.
Okay.
So we're going to look at, just type in Home Depot,
On Google? Or?
stock to Google.
Home Depot stock. Okay.
Okay, so what's the best way to describe this? When there are a few really common misconceptions out there. One of the major ones, which my goal is to squash that, is that price means anything at all. Okay, so a lot of people will look at two companies. So you have Home Depot up.
Yep.
Now let's look at Tesla, because why not? So get that one up as well.
Okay. Got it.
Okay. So you see Home Depot and Tesla. Which stock is more expensive?
Home Depot.
Why?
Could not tell ya. Yeah, Home Depot is about $80 more expensive than Tesla's stock. I think it's because there's more Tesla stock to go around.
That was actually more insightful than you think it was. You're off base completely, but that wasn't bad. Okay, so first off, the reason you could answer that, or you felt like you could answer that question, why did you think you could answer that question so quickly? It's not a trick question.
Okay. I think because of like Tesla, everyone knows how good it is big it is of a stock. The market cap, that's kind of what I looked at specifically. 1 trillion compared to Home Depot's 405 billion. That's just kind of the idea, the train of thought I went on.
Okay, so you said that Home Depot was more expensive though.
Yeah. So because I'm not sure.
I think I know because straight away there's like a big number with at the top it says Depot Inc. and the first number you see in the biggest boldest font is 406.77 and the biggest boldest number you see on Tesla's is 333.86. So immediately your brain is like Home Depot's number is bigger, so it's more expensive. Is that right?
Absolutely. Yeah. So people will look at the price that you're paying for the individual share, not the price you're paying for the company. So when you are valuing a company, it does not matter whether this company shares are $10,000 a share or $5 a share. It tells you nothing about what you are paying for the company. Does that make sense?
Yes.
No.
Oh.
I get mixed reviews.
I'm lost.
Okay, that's fine. That's fine. Okay. So if there's no water in this cup. Okay, so I'm holding a cup of just a cup of water. And let's say there was 250 mils in this cup, right? And I was to then take 10 cups and take this 250 mils and put it into each cup. How much water do I have?
250 milliliters.
Okay. What about if I took it and put it into 2 cups?
250 milliliters.
But how much does each cup have in it?
125.
Or 25 mils, right? So
Depends on how much.
it depends on how many shares have been issued, which is what Nick said about the...
I know my stocks.
Cease is dying laughing over there.
So market cap is a great indicator. There is also what we use ratios to determine whether how much you're paying for a company. And this is where the art, I guess, of stock picking comes into play. First off, full disclosure, I don't think many people should do it. I think it's a losing game. I know it is a losing game. When you look at the data, the vast majority of people that try to pick stocks long term do not outperform the basic indexes. So low cost, globally diversified indexes. Okay, that being said, I enjoy picking stocks. I find it fun. I do not recommend it. I do not do it for clients. No, I follow the data. So that side. Okay, so when you're looking at something like Tesla, you have to then compare it. Tesla's a terrible example, but you have to compare it to other similar companies to determine if this stock is overvalued or undervalued. And there is a lot that goes into researching a stock through the data that is given to us, like the quarterly financials and the earnings reports and things like that. And there's a ton of stuff you would research outside of that. But the important thing for the price, there's a few ratios that you would commonly look at, and they give them to you because they know it's kind of important. So if you go to Tesla, on the first information you see from Google, what does it give you? There's a few ratios there.
Okay, so the big red ratio right now for today is 3.5%.
So that's what it moved.
Yeah,
so that
that's
means
the
that today it was down 3.5%.
Okay.
So if you go to, let me see what your screen looks like. So I can
PE
see.
ratio?
Yeah. Okay. Yeah.
So PE ratio 193.51%.
So what do you think that means?
Price per earning.
I have
Don't
no
whisper
idea.
it.
Oh, sorry. Price per earning.
Yes, it's the PE ratio, price to earnings. So that means how much am I paying per dollar of earnings? So in Tesla, for instance, I'm paying $193 per dollar of earnings. If we go to Home Depot, what are we paying
$27.64.
per earnings, right? So through a price to earning basis, you would say that Tesla is more expensive. So per dollar that Home Depot trades at, it earns, sorry. So per dollar that Home Depot earns, you're paying less per dollar of their earning for Home Depot than you are for Tesla.
So every dollar Home Depot earns, is that right?
Yeah,
Then I
you're
earn.
paying
I'm paying
$27
Oh,
when you're purchasing this stock,
I gotcha.
right? And same for Tesla. You're now paying
Almost $200.
almost $200. And that in itself is not you cannot use that as that's your only source of,
Right.
but that it gives you an idea, or especially of the type of company this is. So a company, the average long-term price to earnings ratio for the entirety of the US stock market sits between $18 and $21, I want to say. So you can see that it is high. I know that if I'm paying $193, it is high. Now, if I'm looking at a stock to buy, now I need to figure out why it's so high. Because it means that people are expecting this to grow into this type of valuation. And there's lots of other metrics, but that's the one that I'm going to stop at because it's the one that's on the main page of Google. But I would just challenge you and everybody else not to think of the price that you're paying. Think about not to think of the price of the share, but to think about the price that you're paying. So there is something that happens in the stock market called a stock split. Do you know what that is?
Nope.
Anyone know what that is?
No.
Okay, so it's when a stock gets too expensive, basically, and the company decides to split that stock into multiple stocks. You're nodding along. So
I've heard of this. Yeah.
Okay, perfect. So companies will do it for all sorts of reasons. It's often to make it more accessible, right, to people, because you can only buy individual stocks typically. So yes, while it doesn't matter technically that the stock is $10,000, maybe most people don't have $10,000 to buy a single share of a company, right? So they'll split it up.
Is this like Bitcoin? Like you don't.
No.
Okay, sorry,
No.
sorry.
No. Not going down that route.
I have a question. So, like, for example, if a company was in a different country and then they wanted to split the stock to be in another country as well, is that something that would?
No, they would just list on multiple platforms.
Oh, okay.
Think of it as we can use NVIDIA, I think.
Or is it like your podcast in different platforms?
No. But I'd see why you'd say that. So type in NVIDIA stock split.
Wow. NVIDIA. Oh, stock split.
Yeah.
Okay.
So I'm just reading the AI overview. Okay. So NVIDIA's most recent stock split was 10-for-1 forward split that became effective June 7th, 2024. So what that means is for every one share that was out there trading, they gave 10 shares instead, and the price of that share divided by 10. So let's say each share was $100, and I owned one share. So I have $100 of stock and I own one share. That on effective June 7th, I now had 10 shares, each for $10.
Oh.
Okay. So it's often like investors will get really happy at this amount of people that I have, like, they attribute growth in a company to like them splitting shares, and they don't understand that the percentage that they own of the company hasn't changed. It doesn't matter that the company split. This company could split 1 million for one. It doesn't matter. You're just, the value of what you have doesn't change with these type of stock splits.
It reminds me of a concept we talked about in the deleted episode that got wrecked. But again, same idea where it's like for some reason human nature is to like make these things up in our head that aren't actually true. And the example we talked about was I had brought something up to Trey, and not to go into details, well, not to talk about the specific situation, but it was me saying, "Oh, why don't we just take this money and put it, instead of like investing it here, why don't we add it to the rest of our money and invest it all together?" And Trey told me like other people have had like thought of this concept, but it's not accurate. Does that make sense? Maybe you should explain it again.
Yeah, I'll explain it again quickly, and then we'll wrap this episode up. So, does anybody have any questions about the stock splits, first of all?
No, I don't think so. It was
No.
almost like your cup.
Yeah.
I just with the PE ratio, I don't understand where they get that from.
So that's where the financials. Have you ever heard of the earnings reports that they do?
Right. Yeah.
So based on the previous earning reports is where this type of information comes from. So it's very simply, you take the market cap and you pretty much divide it by the amount of earnings.
Makes sense.
And that's, you get your price to what the amount of earnings that the company did.
Honestly, all of this just reminds me of like Shark Tank. Is that
Yeah.
kind of right? Like when you hear them having these conversations, I feel like I learned so much just watching that show where they're sitting there asking like, what's the valuation? What are the numbers? What are your sales? What is this? What is this? And then they're like, you're valuing your company. You want me to invest $1 million for 0.5% of your company? Absolutely not. Like I'm out or whatever. That's this, right?
Absolutely. You know what? Shark Tank did so much for financial literacy. I think it probably did more for financial literacy than any other show in history. Yes, absolutely. And you notice that the sharks never ask, oh, how much is it per share? Nobody cares how much it is per share. They can make up however many shares they want. They ask, what's the valuation of the company and what am I paying for this company? That's all they care about. They don't care about the individual stocks. Warren Buffett, anyone know who Warren Buffett is?
Yeah.
Warren Buffett, very famous investor. Basically, the way he invests is he says, turn off the stock market, go value your company, figure out what you're willing to pay for your company, then come back to the stock market. If said price is lower than what you want, buy it. If it is higher than what you want, don't buy it. Like it is very, I do not care what the stock market is doing. Do not care what the stock price is. What I care about is the value that I'm paying. What's the valuation of this company? If I run a lemonade stand on the side of the road and I'm willing to give you $1 million of it, who cares if it's not worth that? Like it's just, I want you to invest $1 million into my company. It doesn't matter if it's not worth $1 million. Like you can't just make up numbers. It has to be worth it. Well, I say that. Stock market's crazy. So they're GameStop.
I'm out.
Yeah, GameStop. Yeah, there's so, yeah, let's ignore that for now. But anyway, I was going to re-explain. Yes. Okay. So oftentimes clients they'll think that they need to merge accounts in order for it to grow faster. So let's say they have realistically 5 different RSPs, each invested in different places, or they have like a pension account or something like that. And they think to themselves, hey, if I merge these accounts together, it will grow faster. Was what we was talking about. And that's not how it works. It doesn't matter if you have $100,000 split between 5 different accounts, each with $20,000 in, and they're all holding the S&P 500, it's going to grow the same way in 5 accounts as it is in 1 account. It doesn't matter that it's in 5 different accounts. But a lot of people do think that, put it together, that it will grow faster. It's not quite the way it works, but it is nice for things to be in 1 account, right? Like it feels, having $10,000 in 10 accounts doesn't feel like you have $100,000, but having $100,000 in 1 account and seeing it go up and down makes you like, it feels like you have $100,000. That's cool. So yeah, that's just a human thing. I don't even know why we think that, but it's very common. If that's how you've ever felt, it's very, very common, but not quite true. Anyway, I'm not going to go through the last topic because it is 42 minutes long. Now you know how the episodes go on for so long. Any final comments from anybody?
I love me a long episode.
No final thoughts here.
You know what the cool thing was? They said was out at the shops, and they said that we've tried a few different things for financial teaching and literacy, and they said this was the first one that they actually could listen to.
I've learned so much, and it's pretty entertaining. So I'm happy to have a small part in joining the show.
Yeah, I gotta say thanks for inviting us.
It was more of like a you forced your way on, but sure, yeah. we'll
Thanks
go with
for
the
inviting
invitation.
us.
Trey begged us.
He set it up right away when he heard that we wanted to do a podcast.
Okay, see you guys in the next one. Will be on TFSAs, and we'll see you in that one. Bye.
Bye.
Thanks for listening to this episode of the Plain English Finance Podcast. Trey Bino, Certified Financial Planner, Chartered Investment Manager, is a financial planner with TC Wealth Management and Aviso Wealth. You should always consult with your financial, legal, and tax advisors before making changes. This podcast is provided as a general source of information and should not be considered personal investment advice or solicitation to buy or sell any securities. The views expressed are those of the individual and are not necessarily those of Aviso Financial Inc. Mutual funds and other securities offered through Aviso Wealth, a division of Aviso Financial Inc.